This is Akashvani. In the program Spotlight, now we bring a discussion on RBI's Monetary Policy Committee's decision. The participants are Anil Padmanabhan, Economic Analyst, and Anubha Rohatagi, Anchor.
The Reserve Bank of India's Monetary Policy Committee, MPC, today decided to continue with the pause on interest rate hike, keeping the repo rates unchanged at 6.5%. To discuss more on this issue as well as the other highlights of the MPC meeting, I am now joined by Economic Analyst Anil Padmanabhan. Mr. Padmanabhan, welcome to the program.
Thank you, Anubha.
Mr. Padmanabhan, as was being widely anticipated, the Reserve Bank of India has stayed with the 6.5% repo rate this time too, making it the fifth time that the central bank has opted not to raise the rates. Now, your initial comments on the factors that led to the central bank decision.
Anubha, in many ways, most of us did not expect a rate cut in this round. And the Reserve Bank of India has reconfirmed most of the expectations. But there is a hint of optimism as well as a note of caution in what the governor said today. He specifically said that in the inflation front, the summer of 22 is behind us. So very clearly the peak of inflation and the wrath of inflation is behind us. But he said the steady decline of inflation, we will keep a watchful eye on it. And if in any way we feel that disinflation trend will be disrupted, we will intervene. So, which basically told us that the worst of inflation is behind us, but the battle against inflation is not over. Even though inflation is below the 5% level, it is still not in the comfort zone where it is. And it is watchful of the fact that there can be pressures on inflation from two fronts. One is food inflation due to primarily the shortfall or the below normal rainfall that has happened. That could be one reason. Second, external shocks could still happen, particularly because of fluid geopolitics. We are seeing that in the price of oil, it's getting very volatile, and OPEC has announced that it is going for a fresh round of cuts. So on both counts, there's a need to be watchful, and that message has come through from the governor's statement today.
Mr. Padmanabhan, you mentioned three things right now. You said the battle from the governor's commentary, it's very clear that the battle is not over on reining in inflation. Food inflation is a very sticky point. You mentioned geopolitical, scenario at the moment. So is that why the central bank has retained the inflation forecast for the financial year 24 at 5.4%? Because like you said, he did express concern at the rising food prices, and he did say that this may drive up the headline consumer price index or a CPI-based inflation in November and December. And he also said, what you also just said now, that there's still a distance to cover to reach the 4% target. So is that why he has not given any forward guidance on the interest rate trajectory?
Absolutely, Anubha, because it is still very uncertain environment out there. And I just want to flag to you the fact that we are forgetting our recent economic history. Even 2 years ago, India's macroeconomic environment was even more uncertain than it was today, even while the world economy was going through extreme volatility. Even now, the world economy is still in a bad place, which is why global trade is in the doldrums. The United States, we are still talking about a soft landing or a possibility of a recession. Same with Europe, same with UK. So it's a very difficult world out there, and India has traversed enormous distance pretty well without subjecting the economy to any structural shocks. But like we just discussed, there are some threats which can surface anytime, and given the track record of last 3 years where every quarter has had to tell a different story, I would prefer to be cautious rather than be regretful later.
Now, RBI's decision to retain the repo rate at the existing level does impact the lending and borrowing rates of the commercial banks. Would you agree that consistent lending rates have the potential to encourage investments, fostering economic growth?
The larger point here is that, high interest rate is a barrier for borrowing, but the bigger problem is that we are not seeing the kind of investment demand coming from India Inc. as yet. And this is not something new. This has been in place since 2008, since the global financial crisis. India Inc. has gone into some kind of funk. They have not yet revived their investment. So interest rates being high or low is not so significant at this time. Also, please remember that in the last 5 or 6 years, The Reserve Bank of India and the Government of India worked in tandem to clean up the balance sheets of the banks and improve the balance sheet of companies who had borrowed from the banks. So today, circumstantially, India Inc. is in a perfect place to borrow, but they continue to be very, risk averse, and they are still not coming back in a big way. We do see investment happening, but right now the economy is still running on one cylinder, which is union government spending and the state government spending. We have just seen recent round of data from some of the state governments. They have stepped up capital expenditure in a big way, just like the union government has been doing for the last 3 years.
Now, the RBI governor's commentary also spoke about what he said. Focus would continue to be on the withdrawal of accommodation stance. What exactly does it mean, and what does it mean for the economy?
But that is a case of liquidity management. So earlier, the circumstances are very different. Let's look at the COVID era. So there was a huge amount of liquidity that was poured into the system to make sure that, people's working capital needs, etc., particularly the small and medium enterprise, etc., are not impacted. Today, as the economy gains momentum, we are seeing that in every which way we look. In fact, the governor in his statement particularly referred to the fact that the e-way bills for October this year was up by 30.5%. Toll collections were up by 13%. Port traffic by 13.8%. Railway freight traffic by 8.5%. Diesel consumption by 9.3%. And even port traffic up by 17%. So they are seeing that economic activity is coming back. So this is a time when if you have excess liquidity in the system, it can become an inflationary challenge. Because inflation is also driven by excess money running behind fewer goods. So when you know there is a supply side issue, you have to be extra careful on how you manage the liquidity. That is what he's signaling. That the liquidity will be managed, but they have so far, touchwood, it has managed it very optimally. It has never been excess, never been too little. So they have done a good job so far. Presumably, they will keep up the good work.
Now, while staying with its inflation forecast, the RBI has done an upward revision in the GDP figures, raising it to 7% from the existing 6.5% for the present financial year. Now, going by the all-round positive indicators, as you were just mentioning, which includes the second quarter GDP figures, the ever-increasing GST collections, the latest manufacturing PMI, how do you view this revision? Would you say that this was expected?
No, Anubha, it was not expected, but so was the GDP number for Q2, which was totally unexpected. It came in at a massive 7.6%. And within that, manufacturing grew something like 13.9%. So the RBI has been quick to take note. And as I just listed to you, it is not just manufacturing. We are seeing that broad level of double-digit growth in various macroeconomic parameters or proxy variables like you would look for. I talked of freight traffic. These are all symptoms of economic momentum. So every which way you look, there is a upward kick in the economic momentum. So the Reserve Bank has acknowledged that because earlier projections were based on a different set of parameters which have changed, obviously. And you see, we don't know what has changed, why it has happened. We'll only know retrospectively because once more and more data come out. But as of now, RBI has been quick to acknowledge that the growth momentum has seen a sharp uptick, which means the overall growth has to be brought up, which is very prudent of them. So they have gone from 6.4, 6.5 now to 7%, which is a very impressive growth, not just for India itself, but in a global situation, India is standing out like a lighthouse as far as economic growth goes.
There have been also some consumer-centric decisions by the MPC today, including one raising the UPI limit for payments to hospitals and educational institutions from the present 1 lakh to 5 lakh rupees per transaction. Then there is also the raising recurring e-payment mandates for mutual fund mandates, insurance premium mandates and credit card repayments from the present 15,000 to 1 lakh rupees. And 3, the RBI has said that it will issue guidelines related to web aggregation of loan products. How will these decisions benefit the common man?
See, Anubha, these are all decisions taken to expand the footprint of the digital economy in India. And the best example of that is obviously the UPI. And UPI it was launched to the soft launch in 2016, but since 2017, 2018, it has taken off and it has never looked back. Today, it is averaging 10 to 11 billion transactions a month, which is staggering compared to where it had started. So the digital economy is, the payments part is not just the growth. There are other forms of the digital economy that are increasingly and rapidly maturing. So I was looking at some new data which was saying that the IPO applications, about 60 to 70% are coming through UPI again. So people are, the digital economy footprint is rapidly expanding. So the Reserve Bank of India is just greasing the system to enhance that expansion so that it becomes even bigger. And the whole logic is that the greater the digital economy, the lesser the friction in the system. In India, the biggest challenge has been friction, which impacts productivity, which impacts growth. So if I solve for friction, I'm solving for growth. So which is why RBI has constantly encouraged growth of the digital economy. In fact, the spread of UPI, they are fully behind its success and should own half of it literally.
Now, just last month, the RBI took steps to tighten norms for unsecured consumer or retail loans. And today, Governor Das said that this was, to quote him, to not wait for the house to catch fire and then act. How important is this in order to preserve the resilience of the finance sector?
Very important. You see, because they may be small sums, but they can create a confidence crisis for the entire financial sector. So we do remember recently, about 6 months ago, the US was hit when a bank had a run because word spread that they were no longer liquid and all the customers ran to withdraw their money and it collapsed. Now, in this case, we are talking about less than 50,000, a large number of loans. The amount may not be much, but because of economic circumstances having gone south in the last few years, primarily because of COVID and subsequent economic shocks, the fear of default was there. And the Reserve Bank has, to be fair to them, has been warning over the last 3-4 months. If you follow the governor's statements, he's been exercising caution, telling the financial sector to be watchful. But recently they increased the warnings and then, of course, they raised the weightage. And now fintechs and NBFCs have begun to roll back the big step up in unsecured loans that they had started. So yes, it is an important step because the Reserve Bank of India is the country's financial regulator, and a regulator's role is not so much in putting out fires as in making sure that no fire is lit in the economy. Yes. And in that sense, caution is a better part of valor.
Central Bank also announced that it will set up a cloud facility for the financial sector to enhance data security and privacy. This has become very important, won't you say? Because with increasing digitization, we are also seeing an increase in financial frauds.
Oh, absolutely. Data security got a big leg up when the Parliament passed the Data Security Bill. So now you have an architecture wherein misuse of data is now a criminal offense. So then there is pressure on every entity handling the data to make sure that the guardrails are in place. So now by creating a cloud facility which ensures secure data exchange, the Reserve Bank is taking this to its logical conclusion. See, without data security, the biggest risk, if you ask me today, facing not just India but the entire world, is data security. So you hear about hackings, you hear about all kinds of attacks which happen, or certain which monitors it is constantly putting out bulletins about being watchful about data breaches, etc. So no matter how hard you work on data, you will always be vulnerable to a breach. So the guardrails, to have a data architecture with very strong guardrails and constant monitoring, is a great idea and should be encouraged.
Thank you so much for speaking to us, Mr. Padmanabhan.
Thank you, Anubha.
You were listening to a discussion on RBI's Monetary Policy Committee's decision. The participants were Anil Padmanabhan, Economic Analyst, and Anubha Rohatgi, Anchor. This program was produced and presented by the News Services Division of Akashvani. You can listen to it on our mobile app, News on AIR. This program is also available on our YouTube channel, News on AIR Official. You may share your feedback about this program through email at airnsttalks@gmail.com or WhatsApp on 9289094044.